This is Brad Hettich with Commercial Lending X. I am coming to you today to talk about tariffs and the impact on commercial lending, as well as what's going on in the lending world in general. And if you stay to the very end, I will give you some potential updates of changes coming to the SBA loan program. Now, I know the discussion on tariffs is changing every day as the administration changes what they're doing in response to different countries' responses to tariffs. So what's going on with tariffs today may be different tomorrow or a week from now or a month from now. However, I intend to keep my tariff discussion primarily focused on what is going on in the economy and how I'm perceiving it to impact the economy, which will matter whether it's 10% tariffs or 100% tariffs. So I'm trying to keep it more generalized like that. Now, as it relates to lending, we are already seeing an impact from tariffs. Lenders are looking at every new request in every business and examining the risk that business may have related to tariffs. This is especially important if your business is involved in international trade. But we're even seeing lenders asking questions related to tariffs and their impact for businesses that do nothing with international trade. If your business is involved in international trade, you need to be aware and ready to answer the questions lenders are going to ask. And they're not just going to look at your business, but they're also going to look at your suppliers as well as your customers and try to understand how tariffs are going to impact them. Secondarily, lenders are concerned about increases potentially coming to interest rates related to tariffs. If tariffs do end up being inflationary, lenders are concerned that could cause the Fed to raise interest rates. Now, we have not seen this broadly across the board yet. We are starting to hear some lenders talking about possibly stress testing loans at higher interest rates. Stress testing of loans was happening quite a bit when interest rates were going up, but it kind of flatlined since the Fed indicated that they had frozen interest rates and it looked like interest rates were going to come back down later this year and started to come back down last year. What stress testing is, it's where lenders underwrite loans at above market interest rates to be sure that if interest rates go up in the future, those loans could still support those higher interest rates. Sometimes this could make a business that would qualify under current interest rates not qualify if that higher interest rate stresses the cash flow too much. Again, we're not seeing lenders do this broadly, but we have heard some initial discussions of lenders that may start to do this again. So it's something to watch out for. The third major thing lenders are worried about is a recession. Although there was already a little bit of concern that we could be starting to go into a recession just due to the time frame of economic trends, there's a lot of concern from lenders that inflation could raise that risk, and that the tariffs specifically with inflation could raise that risk. Now, that has lenders being a little bit more cautious about doing deals with businesses that are higher risk or that are a little bit on the cusp economically. So lenders are underwriting deals harder related to recessionary concerns. There are some other concerns facing lenders right now. Generally speaking, over the last couple of years, the default rates on commercial loans have gone up quite a bit. Whenever default rates go up, that does cause credit managers and lending managers to be more conservative in underwriting. So we have been seeing a tightening of credit in general over the past about 24 months, which appears to be continuing now with some inflationary concerns. And those default rates are across the board, both in general commercial loans as well as SBA loans have seen an uptick in default rates. Lenders continue to be concerned about deposits and capital. Ever since there was that tightening of capital and deposits about 24 months ago, banks have continued to be cautious about how they're doing their lending and being sure that they're well capitalized and very focused on maintaining quality deposits. And then kind of the third thing is that under the previous administration, there was a lot of tightening of regulation on the banking industry, as well as some requirements coming down that were going to force banks to keep more capital on their books. Now, it's not clear with the current administration if these things are going to be lessened, but a lot of people do believe some of these criteria are going to lessen, which could help improve lending going forward. but at least in the short term, it is going to continue to be a risk for banks that are concerned about tightening capital. So, are we still getting deals done? Most certainly we are. We just came off a record March. We have a really good pipeline going into the next quarter. We still have lenders willing to lend money. It's just that they're asking more questions, they're digging deeper, and we're having to talk to more lenders to get deals done. So the process is a little bit more difficult, and like I said, has been getting a bit more difficult over the last 12 to 24 months. But hopefully this will be short-lived and we'll be through it shortly. Now, I do want to talk about my opinion on tariffs and what I think the ultimate impact is going to be on the economy. And my opinion has been informed from talking to business owners, talking to lenders, from the bank consulting work we do on our bank consulting division, the financial reporting we're seeing from clients, and all the loans that we're looking at, the economists we follow, as well as kind of the geopolitical stuff we watch and follow. I'm not meaning any of this to be any sort of political stance. I'm merely going to express my opinion here. And my opinion is really more general on what I think the impact of tariffs is going to be long term and what we can expect from lenders in the economy. Um, and from a professional opinion, I think the Fed, as it relates to interest rates, is going to keep interest rates kind of where they're at today. The prime rate's currently at 7.5%. I don't see that moving. I think the Fed is going to be cautious that we may see inflation come about from tariffs. And so they're not going to really move rates down like everybody was expecting. If it doesn't materialize, hopefully interest rates will come down later this year. But at the moment, I expect them to kind of hold rates flat. The good news is that the March inflation numbers were down at only 2.8%, not quite to the 2% target that the Fed has, but certainly any downward trend is a positive. I think long-term interest rates are going to continue to bounce around. That's really going to be in response to what's happening in the market in general. As we get good news, long-term rates could go down. If there's some questionable things or concerns, long-term rates could go up. The interest rates to really watch are the 5 and 10-year treasuries, which have bounced around quite a bit over the last 2 weeks. And I also believe the stock market volatility is going to be here in the short term. I think the market and people are going to continue to react on every bit of news related to tariffs, positive and negative. And people have to get used to the fact that the stock market's going to move. Although it does represent people's feelings about where the economy is going, it doesn't always end up reflecting what the final result is going to be. So I encourage people to kind of be calm about these movements in the stock market. Overall, though, I am bullish on the economy as it relates to tariffs, and there's a number of reasons why. First, as it relates to inflation, only 15% of our economy is is imports. So it's a very small percentage of our overall economy that could be impacted by imports. If you look at just the fact that there is a 10% across the board tariff in place currently, ignoring some of the other specific tariffs, and 15% of the economy could be impacted by that 10%. You're talking about maybe a 1.5% impact to prices or other stuff. Not unsubstantial, but not huge, not taking into account any other factors that could exist. However, we already have 75 countries supposedly that have contacted the government to start negotiating new trade deals. So that's a very positive sign. So we may not see the tariff impact for many of these countries be a long-term thing. Most of the additional tariffs have already been put on hold, although there are some specific ones that have not, and we'll have to see how those impact things. We're not taking into account the fact that some international businesses that sell into the US market may eat the tariffs with reduced prices because they have goods they want to sell and they want to stay alive. So they're going to sell them into the US economy, maybe at lower prices to continue to stay in business. You also haven't taken into account US companies seeking alternative sources for products that may be cheaper than where they were getting them before with tariffs. At higher prices, at least for discretionary items, you may see people just not buy as many of them, which in of itself could end up being somewhat deflationary for those products as there's more of them and less money chasing them. You could actually see some prices come down for discretionary items. I'm a big follower of the economist Milton Friedman, and Milton Friedman spends a lot of time talking about how a lot of inflation is driven by government spending. And right now, between Doge and the new budget proposal, which has cuts in it, government spending appears to be going down. So, with that in mind, that is by its nature deflationary and could help offset some inflation that could come from tariffs. Under the previous Trump administration, tariffs went into place, and the impact to inflation was negligible. Now, I know the tariffs are much higher and much broader this time, but it'll be interesting to see how much it does impact inflation this time around. And then lastly, our markets or US companies may be much more competitive in the market overseas if some of these tariffs or trade agreements get put into place or tariffs get reduced from foreign countries to US goods. And that growth could work to offset some of the tariffs on products coming into here as US companies do better. So overall, I'm not going to say inflation isn't going to happen because of the tariffs, but I'm not super concerned about it. I think there's some solid offsets that could make it less risky. Of course, time's only going to tell, but I don't think it's going to be a huge risk. Now, I think the second biggest risk beyond inflation for the US economy is the risk of a recession. And there are a lot of people concerned that tariffs could be recessionary if it slows US GDP growth. Um, Personally, I think the US tariffs are going to work to possibly level the playing field, especially if new trade agreements get worked out with potentially 75 plus countries around the world. But I think there's some other offsets that are going to help reduce the risk of recession. The first being that there's already 5 trillion in commitments, largely going into new manufacturing here in the US. That investment is going to be very strong for the US economy and may help offset some recessionary risks. Again, the fact that new markets may open up in foreign countries for US goods will help US companies grow and could offset inflation risks or recession risks, excuse me. The fact that it could become a more competitive landscape for US manufacturing could be big. And we have continued to see a decline in fuel prices in the US, which really helps manufacturing and helps lower costs. Could be part of the reason why we've seen inflation go down. Inflation hit a low at 2.8% in March of this year. So that's a positive sign. And I will tell you in general, I've been very bullish on US manufacturing for a number of years. I can tell you firsthand with the work I'm doing that I've been seeing manufacturing coming back to the US. A lot of our manufacturing customers have been growing and have been doing very well. And I expect that to continue. I also think all the cheap labor globally has had a negative impact on US manufacturing. A lot of major US manufacturers have been able to take advantage of cheap labor overseas. That has discouraged them from investing in high-tech factories in the US. If some of those competitive advantages go away, either because of tariffs or because of changes in the labor markets in foreign countries with renegotiated trade agreements, then you could see those companies invest in high-tech manufacturing here in the US, which would make those products competitive even when produced here, despite higher labor costs. So overall, I am feel pretty strongly that the economy is going to be resilient through this. I'm not saying there's not going to be some problems. We could potentially have a short or small recession, but overall, I'm not super concerned about it being a long-term problem. Now, as it relates to China, that's kind of a bit of a different story. It's going to ultimately take longer, it appears, to work out some trade agreements with China, and that could be a little bit more impactful on our economy. However, I ultimately believe a deal will get worked out with China for a number of reasons. First, roughly 38% of China's GDP is related to import and exports. That compares to 25% of US GDP that's import and export. However, on the US side, we do a lot with many, many countries, not only Canada and Mexico, as well as China, but also many other Eastern countries, Europe, etc. So I think the impact to the US is going to be much less than it is on China with this kind of brewing trade war between the US and China. Secondarily, a lot of economists say that the Chinese economy needs 4% growth or more per year just to meet up with sustainability for their overall economy and their population. And that GDP growth has been down. So certainly high tariffs out of the US could put a lot of pressure on that GDP and that growth, and that's going to be a huge issue for their government to get over. China's also had a lot of economic issues lately, as I already stated, slowing GDP, which has been a concern for them even before the tariffs. But then they also had roughly a year ago a collapse in their real estate markets. So they're already under some pretty hard economic stresses. So these tariffs are just going to make that worse. So I think ultimately China's going to be forced to the table. There's going to be a lot of saber rattling and a lot of pushback initially, but I think ultimately agreement will get signed between both nations. And it's quite frankly to the benefit of both countries to do so. Um, as it relates to the stock market, as I've already said, I think stock market volatility is going to continue to exist as long as the tariff battle exists. It's going to go up and down. But one thing I'd like to point out is back in 2021, the high for the market, Dow Jones Industrial Average, that is, was about 25,000. And prior to the tariffs going into place, we were hitting a high point in the Jones Industrials of about 45,000. The largest movement we probably had so far has been about 2 to 3,000 points with the tariffs. So that's putting you at Dow Jones Industrials about 42,000 points. The market is still way ahead of where it used to be, and the market tends to move more on emotions than anything else. So I don't want to say it doesn't show what some long-term economic trends will be, but it also moves a lot with emotions on a short-term basis. So although I think the volatility is here, I still think overall we're going to maintain a pretty healthy stock market for the near term. And one other thing to keep in mind, this kind of tariff situation, tariff battle, whatever you want to call it, is not like a permanent problem. It's not like going back to the Y2K crisis or the Great Recession or the Great Depression or even COVID. This is something that our government's created to try to work out better trade agreements. It's not a permanent thing. It could be reversed by just canceling tariffs if the need ever came to it. So, with that in mind, I don't think that it's going to really have a long-term underlying impact. It could have a long-term underlying benefit, but not really a long-term underlying negative impact, in my opinion. So, overall, I think the economy is robust and strong. I'm seeing a lot of good trends with our business owners. So, I think we're going to get through this, hopefully without too much inflation, hopefully without a recession, and hopefully with some strong trade agreements being worked out that encourage investment in the US. Now, I'm going to slide away from that and try to give you some good news. On the SBA loan side, I get questions all the time since there's been some announced cuts in employees with the SBA and concerns that the SBA guarantee programs are going to go away. So far, a majority of the employee cuts have been in programs outside of the lending programs. So that's good news. The lending programs don't appear to be materially impacted, at least from an employee standpoint. As it relates to the SBA lending programs in general, they're widely supported on both sides of the aisle. Democrats and Republicans have supported the program for years. The current administration is extremely business friendly. So I do not see the SBA loan program going by the side. The only major change to the program at this point has been a change in the government guarantee fees. The previous administration had more or less waived government guarantee fees for loans below $1 million. The current administration reversed that. Guarantee fees are now in place for all government guaranteed SBA loans. The change the previous administration made really went into effect early in 2024. The current fee structure that's now back in place is the original fee structure that was in place before. So it's not something that the program hasn't had before. And one other very important thing to note about the program is this is one of the few programs that's actually profitable for the government. The government is supposed to collect the guarantee fees and use them to pay losses on the program. The government has never paid more in losses in any given year than they've taken in government guarantee fees. So it's really a low risk program for the US government. It has always performed very well and been very successful. So with that in mind, I don't anticipate the program's going to go anywhere. Now, there is a bill in Congress right now looking to increase the amount of loans that any individual borrower or guarantor can qualify for in both the SBA 7A and SBA 504 loan programs up to $10 million. This would be a huge change. It would open up a whole tier of additional lower middle market to middle market businesses to SBA financing that have needs that are currently greater than what the SBA can provide. Another reason why this is big is because the SBA program is a much better program offering longer terms, not requiring full collateral, and other benefits that you just don't get with conventional bank loans. So an expansion in the SBA 7A and SBA 504 programs up to a $10 million cap would be absolutely huge for small business lending in this country and would really help fuel some growth on the small business lending side. So there's not a guarantee this is going to go in effect. There's a bill in Congress that's got both a Democrat and a Republican sponsoring it. But there has been a push for a number of years for this increase. Again, a positive, but also a negative. It hasn't happened in the past. We do have a government that's trying to reduce spending, so it'll be interesting to see if they can increase the SBA program at the same time they're looking to reduce spending. But I do think one of the big pushes on this is the fact that we need to bring manufacturing back to the US, and the SBA is really good for that. So hopefully this increase will take place with that in mind. That pretty much covers the update I have for today. As additional economic news comes out, as additional loan programs or changes to the SBA get announced, we'll get out there and get some information to you. If you have questions in the meantime, check us out on our website, commerciallendingx.com, or you can always email me at brad@commerciallendingx. We look forward to working with you in the future. We wish you the best of luck with you and your business. Hopefully you can survive any concerns with tariffs and any economic concerns that happen in the near term, and we can all be on the other side of this in the next 3 to 6 months. Good luck and have a great day.